Hello and welcome to another installment of Thursday Thoughts. I am Alex Leonida, and my lighting isn't super awesome right now, and I don't know why. These things are super duper bright, so I'm not sure why it's not working as great as usual. But in any event, I am the CIO of Capital Financial Group and the bald dude that's about to share some unbiased knowledge and information with you all. If you guys haven't done so already, please like and subscribe to our Thursday Thoughts, or I guess in this case, our CFG Financial Planning YouTube. It means a lot to us to have the subscribers, and it gives you guys an opportunity to make sure that you don't miss any of the content that we are dropping. I mean, we are regularly posting stuff at this point, trying to be transparent, sharing as much information as humanly possible. So please don't forget to subscribe. Also, as I mentioned the last 2 weeks, take a look at CFGU. It is awesome. I think you guys will really, really like it. And it's a great opportunity to get that core financial planning knowledge that builds a solid base for you and for your kids. So check that out as well. If you guys have any questions, shoot them over to info@cfgfinancialplanning.com. All right. As always, I'm just going to go over a quick rundown of what we're going to cover this week. We are going to hit the data points. That's always first because that's the most important thing to me, and this is my show. So I can do that if I want to. So big data releases, we kind of teased that in the Monday Morning Minute. We have big news stories coming in hot. I know that there's a lot of super dramatic stuff happening right now, but I'm trying to focus my news stories on stuff that's relevant to your portfolio. So please don't be bummed if I don't talk about some of the really important stuff that seems to be dominating airwaves right now. I just wanted to throw that caveat out there right up front because I'm not going to talk about what y'all are probably thinking about right now. Then we're going to do questions. We have a couple of questions. We actually got quite a few this week. Had one come in at the last second. Unfortunately, I don't think we're going to have time to cover that one, but I will absolutely get to that question. It has to do with the PPP loans and stuff like that. So I'm going to get to that question next week, 100% for sure. And then we're going to close out with the final thought. I got a lot going on up here, so let's get rolling with everything. All right. All right. We got data points. Data points. The nerd in me loves this part. We're starting every week with jobs. That's the deal right now. Whoa, another 2 million jobless claims this week. Blue line, not as bad as the week before that, or whatever, but we are talking a lot of people without a job. Gold line, same deal. On the bright side, things have started to drop off just a touch with continuing claims. Probably has a lot to do with the PPP loans. Some people reopening, being forced to rehire for a small percentage of the population. Only about 30% of the population of unemployed over the last month were actually making more money while they were working, which means 70% of the people that were newly unemployed made more money by being unemployed. We've touched on this like every week. It is a serious problem, but it's nice to see that some continuing claims have dropped off. I think that that's powerful. It means people want to work. The government's just not making it easy on them by paying them a bunch of money to sit on their couch, right? We keep talking about that. So another really, really important piece of data I think this week is our new home sales data and pending home sales data. Last week we had some existing home sales data that was kind of yucky, not cool. And this data is not particularly cool either, although we did have a surprise to the upside. New single family home sales, that's the blue line right there. It actually bounced back a little bit, which is awesome. Most people are expecting this to continue to drop, essentially on the same trajectory as the gold line, which brings me to my next point. The gold line is pending home sales. So we have houses going under contract, right? That's the gold line, those pending home sales. essentially over the last month, people stopped going under contract. They just stopped, and the existing ones that were under contract already, they closed, which gave us a little bit of that B-shaped recovery in the new home sales. Boom, making it look like the real estate market is a little bit more healthy. But now we have like almost nobody going under contract. Like that is a big, big deal. Um, I mean, it's a scenario where what do you do if you're in the real estate market? Um, Something I didn't put on the chart, but I think is really important is we now are up to a 6 month supply in the United States in available homes. That's a lot. That's getting back to historic averages, going back a long, long time. I mean, through this ramp up, when we saw continuing home price increases over and over and over again, things were getting better and better. Everybody's nest egg was all juiced into their house, making so much money on your house. We saw that kind of collapse in '07, '08, whatever, but it's recovered mightily since then. And now we're in a scenario where I think finally buyers are going to have a little bit of leverage because there's a lot more choices for most parts of the country, right? I get it. If you live where I live, you know that there's not 6 months of supply. So I'm with y'all on that. I get it. But for the entire country, we have a 6 month supply that is back on long term old school trend, which means we're not going to be seeing like 10%, 5%, 10% increases in home prices every single year. A very, very small group of suburban areas and some urban areas might still see increases like that, but this is a supply demand business. And when you got too much supply, you guys know how that whole thing shakes out. So I just wanted to let you guys know while it seems good on the surface, it's kind of, if you dig a little deeper, not super awesome. It is what it is. I'm just here to report the data. Next up is actually, I'm not going to give you a chart on this because this was just a revision. This is GDP. I told you guys that this was coming out in the Monday Morning Minute. And if you don't watch the Monday Morning Minute, you should check it out every week because I kind of tease everything that's going to happen or what I'm going to talk about in these videos. So we had our second revision to first quarter GDP. It was he was ugly. Originally, they were thinking about 4.5 to 4.75% annualized decline. They've revised that down to a 5% annualized decline, which is yucky. That's bad. Um, and what's crazy is we only had like a month ish of legitimate COVID lockdowns across the country. Obviously, certain parts of the country, certain states were a little more aggressive than others, but the whole country was semi shut down for only about a month of this period, and um, data's not looking super good. I think this matters the most because with these revisions, we get a clearer picture of what's really happening, and it with the next GDP print, it's going to give us a true idea in terms of rate of change. If this stock market has gotten way ahead of itself, or if we're just missing something analyzing this data right now. Next up on the list, I know you're excited. You get another chart. Is durable goods. You're probably like, "Yo, Alex, what are durable goods?" Um, it's actually simpler than you may think. They are goods that are supposed to last longer than 3 years. These are going to be higher ticket items that people don't buy very often. These are not your consumables, right? And this chart is showing badness, Danny. Sorry, super cheesy, Caddyshack reference, but you're gonna get what you're gonna get with me. Yeah, this is not for goodness. This is for badness. Um, Now, historically speaking, if you look back, I only did three years because the chart gets convoluted when I go out 10 or 15 or 20 years. But it looks the same the whole way through. You normally have a couple of up months and then a down month or whatever. That's normal because that has a lot to do with supplies and inventory the companies have on the shelves, right? With reopenings happening right now, you would expect next month that crazy line down for 2 consecutive months, huge drops for 2 consecutive months, which in and of itself is unprecedented. That's for you if you're watching. I said it right. Um, 2 months in a row like that is not normal. So if next month is bad with people going back to work, then watch out below. That's all I got to say about that. That's why we're not all bulled up on manufacturing companies, and we're having a hard time getting excited about this fear of missing out rally thing that's going on right now. The data is just not with those folks. It's not looking pretty. Um, all right, so now that we got those data points knocked out, we are going to jump into the news side of this whole deal and just staying with the repetitiveness and wanting to uh, show rate of change and important pieces every single week, at least for the foreseeable future. We're going to do COVID first. Um, I mixed up the chart just a little bit this time. I decided to do daily change so we can get a real clear picture of the curve. I showed how the overall numbers, the curve wasn't really flattening out on a relative basis. But what we're seeing here now is like we've essentially peaked out. The first set of data right here, the top chart that you have on this is your coronavirus cases per day. Um, it's a little better, right? I shouldn't say better, it's getting less bad, which is what we want to see. Now we're a week or so into the reopening process, about 2 weeks into the reopening process for some parts of the country, and we're not seeing a massive spike yet. But like I talked about last week, it's really important to point out that there's sometimes a 10-day to 2-week lead time before people are getting hit with symptoms on this thing. And we really don't know now that restaurants are starting to open if there's going to be that person-to-person contact. Moving on here, second chart is going to be deaths per day. That number is improving exponentially. That is a good thing, but people have a tendency to spend a week or two in the hospital before um, they die. So we're going to have to wait for another week or two before this data becomes definitive, but it's not looking as bad as I was possibly expecting. And the last one is current hospitalizations per day. And that, although it has definitely come down, and most of this is because things have calmed down a little bit in New York, but it has come down quite a bit, but it is pretty stagnant. If the number starts making a pretty appreciable move to the downside, that is an absolute good thing. And that's what we're looking for and hoping for, because I know I say hope is not an investment strategy, but in this particular instance, it is absolutely a praying for everybody around us and their safety strategy. That is a real thing. All right, next up on the list, we got trade war. I'm sure people are a little bit distracted with a lot of the dramatic news that's breaking everybody's heart right now. Or I mean, I don't know what it's making you feel like, but it's kind of yucky inside. But you probably missed this. It's possible. And what I'm talking about is Trump taking it to Huawei. Not a recommendation to buy or sell, for sure. I have absolutely no interest in this a company. We don't own it. We don't make recommendations on it right now. So totally safe to talk about this, right? Um, Basically, what's going on is the administration has put a ban on chip makers selling their products to Huawei if this is a big if those chips were developed and processed on U.S. machines and then also using U.S. technology, which almost all highly advanced chips originated here, or at least the technology, or at least the machines that develop these things. So, countries that are really affected by this, mostly South Korea. I know that there's some issues in Taiwan because they're trying to figure out if they want to risk hacking off China or not. But bottom line is they're using U.S. technology, and I don't think that they want to be a target of the trade war either. So it's going to be really interesting to see how this whole deal plays out. I mean, a lot of people are saying right now on TV that we're losing our standing as a world leader. But I would argue that we're using our standing to lead. Thought process is, regardless of where you stand politically on this, thought process is we have to save our intellectual property. That was the whole reason we started the trade war in the first place. And in this particular case, we are trying to force a company that directly benefits from stealing American IP We are trying to prevent that from happening in the future by attacking essentially China's most robust technology company. So we're going to have to see how this thing plays out, but it is definitely something I'm going to be looking at over the next couple of weeks. I'm just interested on a personal level. We all know that that's bad for Huawei. I mean, no chips, no cell phones, no 5G, bad. Um, but I'm curious to see what happens in terms of China retaliating or whatever. I mean, it could be bad for soybeans. I don't know. Um, but in any event, I still think that this is a really, really important piece of news that some people might have overlooked this week. Next up on the list is one that I am almost positive you overlooked. And this is a super, super boring chart. You're like, what is this? Take this off my screen. Um, but all the way on the right side of this chart, we have 1 trillion, $1 trillion of new U.S. corporate debt. 1 trillion. Marriott actually just tipped the scale and sent it over 1 trillion with a big bond deal they just did. Not a recommendation to buy or sell Marriott, just saying who did it. Okay, it's the news. Um, but I mean, it's pretty crazy. $1 trillion, right? Look at this thing. All right. So what this chart is showing you is that this far into the year, as in the end of May, where corporate debt issuance normally is, right? We're talking this. We are 100% above right now where we're supposed to be this far into the year. That's crazy. I mean, the liquidity provided by the Federal Reserve is obviously a driver for this because everybody has heard. I mean, my whole rant was about how the Fed shouldn't be buying corporate bonds. But the bottom line is, even though they got a lot of money set aside to save the bond market, they haven't. They have not bought a single bond yet. They've been out there buying ETFs here and there, and they actually enlisted the help of the world's largest asset manager. You can Google it if you don't know what it is, to help them process transactions in the ETF markets. But they have not bought a single individual bond yet. And everyone's like, whoa, let's get out there and just like sling debt everywhere. On the surface, this is good for one reason, and it gives liquidity to these companies that are struggling. And they need that right now. But what's kind of freaky and kind of scary is that they are blowing up their balance sheets. Like it is, whoa. We're talking like debt to equity levels. I mean, I could go into a whole swath of reasons why this is going to make companies look less attractive from a fundamental perspective. But it is, I don't know. I'm not a big leverage guy, you know. It definitely has its time and place, but this is absurd. Um, I will say though, it is reasonably nice to know that these companies have enough liquidity to survive at least over the short term. And the one bright side to the fact that they're leveraging themselves is they happen to be leveraging themselves at historically low rates right now, which is a good thing. All right. So moving on now, we're going to jump into questions. Like I said, we actually had quite a few questions this week. The first question is from a new client. So thank you for participating. That is awesome. Um, the question reads like this. Where do we see opportunity in stocks as more and more education goes online? Super interesting question to think about. I mean, from my perspective, there are a few companies out there that are strategically positioned to benefit from this, but most companies aren't going to be able to like monetize this really easily because a lot of their software is free right now or bundled or already existing inside of packages that almost everybody has. I can't talk about specific companies in this answer. So if you want to connect to dig a little bit deeper, shoot a request to info@cfgfinancialplanning.com, and I will be happy to go in a little more detail, and we can talk about how it might affect your specific portfolio. But the most disruptive companies out there are going to find themselves in an opportunity that you rarely see, generational style opportunity. This is all, of course, assuming that colleges don't go back to campus in the fall and public schools aren't going back. And I mean, we don't know if that's happening yet, um, but it looks like it might. I will say that there are going to be universities that deliver content and information and learning experiences online as more of their go-to strategy moving forward. There's going to be some universities that are forced to close, right? So the whole idea is if there's a company out there that is going to make things profitable and help universities stay solvent while still serving their population of students, et cetera, those are going to be the types of companies that would possibly or realistically provide an opportunity in this environment. Um, the second question is actually a tough one. Um, there's going to be some opinion in this. So I hope I don't offend anybody. I have to answer this with a little bit of opinion because my knowledge depth isn't infinite on this topic. But the question is, what happens now that China is claiming Hong Kong is no longer autonomous? So this is where I might irritate some people. So sorry in advance. But first of all, Hong Kong has never really been autonomous, right? I mean, China has always put a little puppet in charge that they can manipulate, and some are worse than others. Sometimes China is a little stricter than other times. Yada yada. It is what it is. But Hong Kong has always just been kind of like the slightly more capitalist, slightly less communist stepchild of China. But I think we all know, realistically speaking, if China wanted to tighten the screws on Hong Kong, they could, and that's what's happening right now. But they allowed this flexibility to happen in the past because they were just trying to attract outside investment. And normally, what would happen is it would flow into Hong Kong and then it would somehow make its way into mainland China. This is not universal, but that's kind of the way it's been designed and the way it's always worked. Um, I don't know what's going to happen with this. I mean, I'm pretty sure there's going to be more riots. Um, there's gonna be there's gonna be more deaths, which is tragic. And international investment's gonna slow into Hong Kong, obviously, um, because of all of this. So I don't know. I realistically, I think this puts the United States in a stronger position to negotiate in terms of trade. You couple all of this geopolitical drama in Southeast Asia with us shutting down the semiconductor shipments to Huawei, and you have a really, really interesting deal to watch over in China. So I can't tell you definitively what's going to happen, but what I can say is it's going to be very interesting TV, and I think we're all on the edge of our seats figuring out what's going to happen next with China because they are battling so many things on so many different fronts right now. All right, cool. Now, my favorite time for the final thought. And my final thought is it's going to get a little political this week, but it's really not it's not partisan, right? And my final thought is this: why, oh, why is our tweeter in chief trying to regulate the internet? I mean, didn't he just blow up the whole internet regulation thing that was supposed to be making the internet more fair for people and whatever? He removed all the restrictions. And now he wants to go after social media and regulate the giant free internet machine. I mean, all right, here's the deal. Trump doesn't like being fact checked. Okay? Love him or hate him. Whether you believe his word is the gospel or if you think he is totally full of it. One thing we can all agree on is he hates it when people fact check him. All right? So that's why he's going after social media right now. And frankly, social media should leave it to the community to do fact checking, right? The actual companies themselves, at least in my opinion, shouldn't be the ones doing the policing. I mean, the community is robust and people, I mean, they are very self involved and they will tell you what they think, right? So, from my perspective, let the community police the deal, right? I mean, I get why he wants to go after them because he's annoyed, But the problem with the whole trying to regulate social media is you can't. Okay? I mean, here's some irony for you, okay? Here's some irony. I don't know if you guys remember this, but a couple months ago, or maybe even, gosh, time flies right now when every day is Groundhog Day. Um, so let's say a year ago. I don't know the exact date, but I mean, Facebook was having problems with fake news, right? And they tried to fix it. They tried to fix it by having some of their technicians go in and start monitoring posts and trying to kind of filter out the stuff that is clearly lies, right? I mean, there was a whole uproar about what's true and what's false and what's fair and what's not fair, et cetera, blah, blah, blah. So they decided they were going to attack that head on. Kudos for trying, but the problem was the technicians were biased and they had a tendency to be overwhelmingly biased in favor of liberal interests. And that's just the way it was. I mean, that is just a fact of the matter. And what's crazy about this is one argument on Capitol Hill with congressional Democrats, and then one lunch meeting later with Donald Trump, boom, everybody's getting a fair shake on Facebook again. So I feel like there's other ways to go about dealing with social media. And I mean, I understand why the president is mad, but the bottom line is CEOs, the president, Congress people, even your local barista has a tendency to think about number one first. I mean, that's the deal. People are self important, right? And that's the beauty of social media. That gives people a platform to just be important, right? They can show people whatever version of their life they want to. I mean, most of it's lies anyway, right? I mean, it's just the nature of the whole animal and what people have become and what our social experiment looks like right now as we live and breathe. Um, I mean, these are the ultimate platforms for people to be important. I mean, I personally hate social media. I use it because it's a way to reach out to clients, to get thoughts out there. But beyond that, I think it's an invasion of privacy. And I'm just uncomfortable with the level of narcissism and, frankly, crap that I see on social media. So I'm just not interested in it. Um, but I think bottom line here is let's just stop messing around with our freedoms. Let's focus on the issues at hand. And social media is not at the forefront, right? We have plenty of problems right now as a nation. So, not that anybody really cares about my opinion. Well, I guess the people watching this do. But I think that our president should focus on what's most important and a little less on what offends him or irritates him. Those are my 2 cents. As always, thank you guys so much for watching. I really appreciate it. You know, like and subscribe right down here. If you guys haven't had an opportunity to do that, I don't want you to miss any videos that we put out. We're working hard on continuing to give you guys valuable content that matters and that could be important and help share some knowledge to help drive transparency in our process and the way that I think about things and we think about things as a firm. And if you guys have any questions for next week, shoot those over to info@cfgfinancialplanning.com. And until next week, cheers. Thanks, guys.